Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 13th, 2022. S&P 500 currently sitting at 4026. I'm David Zarling. I'm here with Ian Amerigo Vespucci McMillan, a great explorer. Ian, sometimes we get weekly price movement, such as last week's. And if you just looked at the closing Fridays, it was as if nothing happened. Maybe something similar developing this Friday. It's as if nothing happened between last Friday and this Friday. Or is it worth doing this podcast? Should we continue?
Yeah, going to be some pretty big weekly handles. I guess more so not a lot happened maybe between Monday's open and Friday's close. Still a gap down off of last week. Also pretty much had a doji.
Right.
Closing near the lows of the week, but also where we opened up. So yes, lots of big intraday volatility still. Not necessarily something you'd see in a healthy market.
Right. And I guess to paint that picture, from the weekly close 2 weeks ago, we're down about 2.5%. But if you were to look at the range of those 3 weeks, we're talking about a range that actually covers about 10%. So if you're just looking at Friday closes, you would think that nothing had happened, but plenty has happened.
I think Bespoke had a good tweet to put this in context, right? We all remember 2017, one of the least volatile years in stock market history. So in all of 2017, Q had only 4 one-day declines of 2%. So 4 down days that were 2% or worse.
The NASDAQ 100 in the year 2017.
Yesterday alone, the NASDAQ had 3 separate drops of at least 2% intraday.
Yeah, intraday. And we've talked about it in the past on here. The
and you had five moves total of at least 2%. it was a wild 10 total moves of 1% or greater yesterday.
In one day.
On
May 12th, 2022.
5 of those were 2% moves, and 3 of those 5 were at least declines of 2% or greater.
Yeah, that's a lot of volatility.
So in a roundabout way, this is really stretching it. But you could say, one could make the argument that there was as much volatility yesterday based on these metrics, which is, a super small niche way to look at this. I admit that. But you could say that yesterday had as much volatility as in the entire year of 2017.
Yeah. And in 2017, it makes sense, right? We had a implied volatility index, the CBOE VIX in 2017 was 10 or lower. We're currently around 29 and 30. And we've talked about that in the past as far as the implications of that and the percentage moves that can happen. And I think of a couple of different things when you bring up that much volatility in one day. Is that would be on a micro time frame, right? So we're talking intraday volatility. The infamous George Soros would say turning points carry the most volatility. So maybe there's a short-term change here in short-term trend. And that's on the minute level. I'm not talking weekly or daily. I'm talking very short-term that would have signified. But we still have a VIX on a daily time frame.
Yeah, VIX never got above 35.
Right.
So kind of, I guess you could say, never confirmed the lower lows on the S&P, if you want to use that, right? VIX breaking out to new highs. I think some would say that confirms when stocks break down to new lows.
Well, yeah,
never got it.
The VIX 35 to 41 level has been important lows for the past 2 years. And I know some people get all tightened up about the fact that you would use a phrase like breakout on the VIX, but I think it's appropriate.
I mean, it is what it is. Like, there's just clear support and resistance. I mean, when VIX sells off 5 times in a row, 6 times in a row at 37, I'm sorry, but that's
right.
Like, that's behavior. That's whatever you want to call it.
So
something to pay attention to. It's a level to pay attention to.
So while 2017 was historically calm, like ridiculously calm, here we continue into 2022 with historically volatile. For example, this is the second worst start to a year in S&P 500 history.
Mm-hmm.
So year to date, going back a couple of days, minus 17.5% in the first 91 trading days. The only worst year than that was 1932. So definitely not out of the woods. We have a downtrend on our hands. Nice client write-up went out explaining that we're still in a downtrend. One of the things we've been looking at, and I know Dan did a nice blog post on this. Talk to me about breadth.
Yeah, still pretty. I mean, nothing that one day is going to fix. New lows continue to outpace new highs. In fact, I think I saw there was 0 new large cap 52-week highs yesterday. And maybe these are signs of capitulation. You've got advanced decline lines confirming new lows. You've got, stocks, percentage of stocks below, I don't know, X moving average, you pick, all confirm. I mean, outside of the Dow. So the Dow has had the best breadth holding up during this last, whatever you want to call it, since the March 4th highs.
Okay.
I mean, really, you could say the last 2 months.
And when we look at in the past, what we've painted a picture of is this weak breadth environment, which has continued, which means, a fair amount of stocks underneath the surface correcting anywhere from 20 to 70%.
Yeah.
And we talked how many times about the big boys that were left: Google, Amazon, Microsoft, Apple. We've lost Google, we've lost Amazon. And what I mean by lost is they've lost significant levels. And what did we see out of what we would call the final 2 all-stars on the team?
They finally broke Apple below, I'd say 150. I'd say 156, but really it was, 150 kind of, I guess, confirms that. Yeah, we're getting a nice bounce today, and a broken rate of trend on Apple.
Yep.
If you want to go back and use, the lows that we've seen really going back to the summer of 2020. And then you've got Microsoft below 276, 274, kind of that area, sitting at 261 right now. Again, and also broken rate of trend.
Yeah, and these are important stocks, right? These are 11%. Those two combined are over 11% of the S&P 500. When your best 2 players on the court get injured, that's really hard for the team overall to do well when the rest of the team has been struggling for the last 12 months. So, and that matches what we've seen in the past few weeks here is just weakness broadly. And you used the word capitulation. We don't know if we're there yet. Capitulation meaning, everybody, we've seen correlations move closer to 1. Correlation, there had been some separation as far as there were several things to participate in over the past few weeks. Those correlations have continued to move to 1, with the exception of, I would argue, energy.
Although energy stalled a little bit here.
Right. It didn't follow to the downside.
No, it has not, totally broken down. In fact, I'd say staples and utilities, healthcare, those defensive areas actually look worse than energy.
Right.
Now they're doing great on a relative basis, but so what would you say? I know that you and I and Kevin and Dan, right, we sit around all day, every day. We talk about this stuff, talk about our feelings on the market, share things. Obviously, on our team, something like today isn't going to fix our intermediate to long-term outlook. I'm not saying that there aren't, there's going to be positions made, probably some time to call mercy on our shorts that we've had on for a long time, which is fine. So what changes what levels on the index would Or maybe not even its levels on the indices. Maybe it's something else. What would change your mind of, okay, this might be a V bottom?
Yeah, I mean, I'm going to quite simply say, have things stop going down, which sounds overly simplistic, but by the very definition, we keep getting lower lows in lots of things, and we need that to stop. And levels always play a role in that. And then I guess I would dovetail and say the best days happen in the worst markets.
They do.
So when you are in a downtrend, the counter trend moves within a downtrend tend to be very fairly violent. For example, I'm guessing the Qs, the NASDAQ 100 being up close to 4% today on a Friday, May 13th, 2022, in an environment of a downtrend is not necessarily the greatest characteristic you want to see.
No.
And the data supports that. I know there's some in the industry who are buy and hold fanatics that say, well, you got to always stay invested because you'll miss the best days. Well, I have news for you. The best days happen in the worst markets.
Yeah.
And they don't happen in a vacuum. They typically are following the worst days in the market, which we've seen this week. There's been some pretty bad days in the market. So our environment. So what's our environmental information? Our environmental information is we're in downtrends across the globe in equities, US. Finally seeing, Apple and Microsoft are following this week, new lower lows, very definition of a downtrend. We would need to see the S&P 500 back above 4220 to be having a conversation about reestablishing an uptrend. Another way this can go is we go further lower and we base out and then move higher. I'm open to that as well. But you brought up some good levels with Apple and Microsoft. If Microsoft's back above 155, if Apple's above 155, if Microsoft's above 275, let's have a conversation about an uptrend beginning. And then all the places that have just been hammered, like IPOs and SPACs and pot stocks and
ARK.
If those can level out and we get some broadening out and increase in breadth, I'd like to see that. We haven't seen that yet. That's what I look at. For me is we are definitely in a primary downtrend. We have flat to falling 200-day moving averages everywhere. That's typically a mess. How about for you? Anything specific that you're looking at in that regard?
Yeah, it's going to be obviously the levels you mentioned. I mean, for me, it's hard. It's hard to get real excited about much when just using your comment of we're in downtrends and what that has done to momentum. And I know that we don't usually moving averages when it comes to making decisions per se, but I think that they're a good tool to use in regards as to what is the overall trend. And we very likely, right? So on most of the major indices, these 200-day, NASDAQ has already started to roll over 200-day. That's only going to get worse. Obviously, we know the Russell's had a horrible 200-day moving average for a while. S&P has also started to roll over. That will only get worse. So for me, I'm eyeing honestly kind of places to reload the bearish thesis as we move higher into that.
Right. Because we know that these rallies can be 20-30%.
Mm-hmm. Oh, Roke had a great slide on this at the CMT symposium. But you look at something like the NASDAQ during 2000 to 2003, you had rallies of 42%, 30, 52, 58, 43 before you bottomed.
Yeah, like all those took place in what was eventually a 70% total drawdown.
And think about this. So we talk about, I know I use this kind of an example of, well, we've gotten pretty extended from these moving averages. All those rallies, all those huge numbers I mentioned, the NASDAQ got back to its 200-day basically on one occasion. That was December 2001. Stayed there for like a month, kind of a little double top, and then sold off. So even on these rallies, we had a 54% rally in the NASDAQ. And at that peak, it was still 30% away from its downward sloping 200-day moving average.
Yeah.
You had before that a 30, whatever it was, 30, 34, 32, somewhere in there rally. At that peak, still 25% below its falling. So, right, there's probably some recency bias when we talk about, how far can we really get away from a 200-day before there needs to be a snapback? It can actually get pretty bad.
Yeah, right. And it can just get worse. Never confuse the bottom of the chart with support. And, for example, these counter trend rallies that you're talking about, even if something like the Russell 2000 were to rally back to its 200-day moving average, possible. That's a 20% move and does not fix anything and is not at a new high. It hasn't even reclaimed 209, 212 or the 212 area that we've talked about in the past.
No.
And so it doesn't fix anything. And that's the damage that's been done. Another way to look at it is when a great fighter's in the ring and they've gotten hammered a couple times and they've taken some shots to the ribs and they're breaking down. That's what's going on. This market has taken some shots to the ribs.
Yeah, we're probably going to get a bell here and we'll be able to, we'll go see go back to the corner.
Right. And you'll have those counter trend moves. You'll have that rest period. And that's why they call them relief rallies, because it's going to feel great.
Well, and then we've got this idea, right? We're so far below these moving averages. If you want to talk about that, like being quote unquote oversold we may just go sideways until the moving averages catch up. And there's lots of ways for this to play out, or it's a V bottom. And in the end of July, we're sitting here talking about the S&P being at 5,000. That's totally possible.
Yeah,
not where I'd say we're leaning. Definitely not where we're leaning. But if levels continue to be taken out,
correct.
You take out 40. What were those?
41.75.
41.75.
42.20. Then
42.20.
4.555.
4,600. Right now, you say, "Oh my gosh, Ian, that's a 14% rally from here." Yeah, it is. Obviously, we're not going to sit here and wait for those things, but we could go all the way back up there.
We could. We totally could.
September highs. There's so much. There's still so much price history to the left that, and if this downtrend continues, that's still just more and more price history to the left. So yeah, it'll be rough.
Well, and Ian, let me throw this at you. Let's say the all-stars that we talked about, the Google, Amazon, Apple, Microsoft, they continue to correct, but we see a basing underneath the surface. So it would still look like a correction broadly, but we would see a firming up underneath, which would actually be very constructive. That whole scenario would be extremely constructive.
But yes, it could. And I could see so many opportunities, and I'm not saying I wouldn't be included in this, where people start to get a little giddy. You start to see the breadth divergences as the average stock kind of does okay as mega cap tech continues to sell off. It would be like the opposite of 2021, I guess you could say.
Oh yeah, your basic point is you could see something like ARC rally up to $64,
but that's not going to move the S&P.
Correct, but it would broaden out. Like that would be something that would kind of signal a broadening out of breath.
People would be very excited if ARC put in a rally here,
and we rallied. That would be an 80% rally, which people are like, "That's crazy. How are we not back to near highs?" It's compounding math. So go ahead and go through that exercise for yourself. But an 80-some plus rally takes us back to the 236 retracement of ARC's massive downtrend. Takes us back to $65. In that environment, we're likely seeing breadth broaden out. We'd have a breadth divergence most likely on our hands. But does every breadth divergence mark a bottom?
No, we've seen, depending on how you want to measure breadth, we've seen multiple even this year. Right, a lot of people new highs minus new lows, diverged a couple times this year.
Well, when we look at previous bear markets, whether it's bigger ones like 2000 to 2003 or 2008, 2009.
Oh gosh, you see breadth divergences all over the place.
Right.
Well, that's how you get people to believe that the worst is over.
Yeah, and so you just got to continue to be Bayesian and take the data as it comes in and weigh that accordingly, as we've talked about. first things first, we got to clear 4175 on the S&P.
Bottom line.
Like that's just step number one. And it's likely not happening if Apple's not reclaiming important levels and if Microsoft's not reclaiming important levels.
100%.
And so our market environment is downtrend on a daily time frame and now even a weekly time frame. Counter trend moves are possible. They will be violent. They will mark the best days. Best days happen in the worst markets.
Yeah, I mean, think about May 4th.
Right. May the 4th be with you. Another ratio that we like to look at that's not equity based, it's commodity based, is the copper gold ratio.
Copper gold.
Can you talk about the significance of that ratio, why we look at that ratio, and what we're seeing out of it? We've talked about it in the past, but it's always good to refresh why we look at that.
I guess it's a good macro view. Is there more demand? Is there more demand for copper or gold? I guess it's a good risk on.
Yeah.
And look at the world, and maybe there's better examples. Tin versus silver. I don't know.
No, it's a good risk on versus risk off.
Yeah,
gauge.
And it's now, of course, with today's action, it's going to try and save itself here at the depths of despair. We'll see.
Well, yeah, it's been in a range going back to surprise, February of 2021, which is, people need to understand that's when the correction started.
Yeah.
All we've seen
on the Lunch and Learn.
Yep. At the Lunch and Learn, we talked about how many things are down double-digit percents since February and March of 2021. And we've seen this particular important ratio move sideways, which is a risk on, risk off barometer. And so we'll see where this ends up. But today's action does bring it back into the range where the risk on scenario is definitely alive and well. It's definitely possible. Looked like it was breaking down earlier, which would have been risk off. There's still opportunity. And another example of that from the equity space would be an area we like to talk about because of its significance is semiconductors.
Mm-hmm. They're going to save themselves?
Maybe.
I mean, it's got a lot of work to do.
And you look at some of the bigger players in there.
Say NVIDIA. This is NVIDIA. It's up 9.5% today. Even more off. Yeah, if we look at yesterday's intraday lows, up 15% off yesterday's lows, and still down. And I wouldn't touch that chart with a 10-foot pole.
Right, that happens in downtrends, right? And it's 48% off the highs, and that's the type of stuff you see. Are these? I mean,
NVIDIA's
bounces.
Already had one 40% rally during this downtrend. It's had a 28% rally. 16%. I mean, it's the fact that it's a 9%, like you touched on this earlier, but a 6, 7, 8%, 9% up day in a downtrend just absolutely has to be treated differently than, if broad markets were in an uptrend and semiconductors are up 5%, it's pretty good confirmation of what's going on in the market, right?
Right. I absolutely agree.
But in the opposite, in a downtrend, assuming semiconductors still going to be red on the week, yeah.
Well, and you still have the largest weighting.
NVIDIA is going to be down 4% from last Friday's close. Let's say if we were to close here, down 4% for the week, and it's rallied 15% in the last 6 hours of market time.
Yeah, the largest weighting in semiconductors, Taiwan Semiconductors, is still below 109, huge level.
Mm-hmm.
And if that 109 level was tested for over a year and failed, and so if that was all distribution,
and we could come back up there,
we could.
Think about that. You could rally in this stock for months, all summer, right? You get to August and TSM's rallied 27%. I'm willing to bet semiconductors had a good summer, but it wouldn't have fixed anything.
Right. Exactly. And there's a lot of those charts that look like that, where we've broken important levels. We could rally back to those important levels and not have fixed a thing. And we're going to talk about Dow Theory in the extended portion, but it's another warning sign, from the market as far as what we're seeing. So we continue to see market and downtrends. We've talked equities, a little bit about commodities, even commodity, like we talked about correlations going to 1.
Yeah.
We've seen commodities also with an exception to a couple, like oil and
crude has continued
gas.
to consolidate. It hasn't, it's pretty tight. It's definitely still got some pent up energy.
And, I think we look at cotton, that's held up. So there's been some commodities that have held up, but otherwise, you look at silver this week and it had a pretty big breakdown. You look at gold and gold miners and they've just kind of floundered. They haven't really done anything. In fact, gold miners are at a critical point using something like GDX near $30. And this is all happening with, I was going to go to crypto, but I think I want to go dollar first.
Dollar.
Right? The original crypto, the dollar.
I mean, we're all right. We're above 103. So,
and this is a big range, right? If we use something like a trade weighted dollar, this range goes all the way back to 2017. You could argue 2015, but it's a multi-year range. And above there, it opens the door to 120 on a trade weighted dollar.
It does easily. That's your next big behavioral level. This was at the O2 highs.
Yeah. And if a dollar's making that type of move, it's going to have ramifications. And from a sentiment standpoint, I think it'd be so classic to have all the eyes pinned on crypto land while the dollar's breaking out.
Right. And in this February, March 2000, dollar breaks above 103, 104 for the first time in years. And, next few years are pretty rough.
Right.
It's the exact same level. Obviously, it doesn't mean it has to lead to the exact same behavior, but something to think about. We've been here before, similar environment, tech heavy index. I don't know what they were doing to rates back then.
Well, I think it ties into everything because everything's priced in dollars. Even if you want to sell a crypto, a lot of times you're selling it into the dollar, meaning like converting it into a dollar so you can use it. Not everybody, but a lot of we saw pain in crypto this week.
A lot of pain,
and the topic du jour was Luna, correct? Meaning
Luna and
the third largest crypto.
Yeah.
By market. I don't even know if I like using the term market cap for cryptos, but anyway, the third largest behind Bitcoin and Ethereum. And just how long ago was it? Looked like it had a fresh breakout.
Yeah, I remember Pratty posting a chart, a month ago or so.
Right.
And it was
this is why you honor false breakouts. Honor them meaning like you don't need to deal with them when they fail.
This was April 8th, so we'll call it a month ago. This was $117. And
we're down 99.9%.
Yeah. I guess you're up 100% today, but
so think about the third largest market cap item dropping 99%. It's going to have ramifications. I don't care who you are. As far as crypto is concerned, that's going to have ramifications. If the third largest stock in the market by market cap drop 99%, there's going to be problems within that ecosphere.
Mm-hmm. And in fact, you've got crypto. Bitcoin's back under 30,000. These, again, they're bouncing everything today because we've had a little bit of a.
Well, that's a logical place too, right? We talked about Bitcoin 30,000 before. That this is,
but below 30, you've got nothing until 20,000.
Right.
There's nothing standing there.
We saw support at 30,000 for Bitcoin in July of 2021, in June of 2021, and then in January of 21. If that doesn't hold, yet again, another what technicians would call a double top in place and being confirmed. And if you look across enough charts, you'll see we tend to be creating double tops. We're not getting that secondary bounce and creating some type of right shoulder. That's probably too much shop talk for the client section, but there it is. If Bitcoin's below 30,000, it's problematic for that crypto asset. Same thing with Ethereum below 1720.
Let me get your thoughts on yields, interest rates,
yes,
and something that We kind of been waiting for a while. I believe you brought, maybe it was January that you presented on this, but where are we in credit spread world?
Oh yeah, credit spread. So first things first, talking about credit overall, one of the biggest credit instruments on the planet is treasuries. So looking at something like TLT, we did bounce this week a little bit near a logical level. This 112 to 115 area is something that has been support in the past. Whether that holds or not is to be determined, because when we look at aggregate bonds overall, they slice through an important level near 104 using something like AGG.
You're saying that would be the equivalent? Yeah, it would be, right? It would be the equivalent low.
Right, the equivalent low.
Which you're saying would foreshadow. And we've seen this in stocks too, right? I mean, we've seen some indices just blow right through support.
And that's information. If you're cutting through what could or should be support like a hot knife through butter,
yeah,
you got to respect it.
It's information. It doesn't mean technical, right? A lot of people got frustrated with that in March 2020. Oh, this support and resistance doesn't work because it didn't even bounce there on the way down. Yeah, that's telling you a lot.
Yes, absolutely. And the fact that, right, we're seeing the S&P. So we're seeing the S&P 500, second worst start in history. And treasuries can't get a bid. They can't get bought, because that's typically the relationship is risk off environments. We're buying treasuries. But since the start of the year, you have treasuries also down 20%. So those 60-40 portfolios, and we've talked about this plenty, aren't working the way that people intended to them. That risk parity trade not working. And maybe that reasserts itself. I don't know. But your question about credit spreads, when we look at junk or like triple C, so these are your high risk credit instruments that carry higher rates typically. I mean, junk bonds didn't even bounce this week. If we look at high yield using HYG, or we look at JNK, another junk bond measurement or instrument, or if we look at triple C spreads, we're continuing to see them. I mean, they're rising pretty rapidly, which tends to coincide with tightening liquidity, meaning less liquidity in the system.
Yeah.
Which is what we see in bear markets, which is what we see in downtrends.
Well, now we've seen cracks in energy stocks, right?
Yeah.
I mean, your XOMs, your Chevrons are holding up, but
no, that's a great point.
There's a lot of hot flyers out there that have really petered off.
I think that's a fair point to bring up. And I think the reason why you're going there is because a lot of the junk bond space is energy.
Mm-hmm.
But to your point, not all energy has been the same for the past month. For example, while Halliburton was looking good, not looking as good anymore. But your bigger names like Valero and XOM doing okay, your traditional energy names. But it's not, again, it's not the same across the spectrum. It's not same thing with commodities. It used to be all commodities were moving together. Now we're seeing a thinning out, and it's only some commodities that are higher. Same thing in energy. It's only some of the energy complex that's moving higher. One of the high flyers that we had talked about in the past and participated in, actually at an important level today or yesterday, in my opinion, is something like metals and mining, XME, that used to be a leader, pulled back, kind of an important level here. Would you agree at $50?
Yeah, very big level.
So we'll see. We'll see.
And you've had a lot of the natural resources. I mean, if XME can find, yeah, that's logical.
You know, one of the biggest players in that space is BTU, Peabody Energy, pulled back to $19, a previous high. That's typically where we see polarity moving higher, could be. So we'll see. But a lot of the other sectors are not even close to something like this.
No.
There's definitely weakness across the spectrum. And so there hasn't been a lot of places to be. And who knew that energy was going to be the place? Now, trend. It was one of the best performers last year. First quarter continues this month. It makes sense. Trends continue to trend. And maybe we'll see those sell off. But it's interesting to see AGG, aggregate bonds, slice through a level that's important. See credit spreads continue to move higher. within a downtrending market. It all
look at
matches.
munis. Munis didn't even think about bouncing today.
Yeah, are you using something like MUB?
I am using MUB, and
Yeah,
how I don't know where that ends. Like I don't.
And here's the
want
thing
to sound like I'm coming on here and saying the end of the world, but like, holy cow! I mean, something is like you just don't.
Well, and here's the fascinating thing.
It's not normal.
Because how many headlines, Ian, have you said of any municipalities being in trouble or any type of municipal debt defaults? Have you seen any headlines like that?
No.
So here we have municipal bonds using something like.
You got to think these. I mean, if our federal government is, you got to think local governments have worked themselves into a situation where, yeah, I mean, if these rates go higher.
And my point is, prices already moved 10%. So once the news comes out, it's too late. That's my point. Is there someone in trouble? Maybe. I have no idea. But all I know is the price chart's telling us we're slicing through levels in municipal bonds that tells me there's something wrong. I don't need to know exactly what it is. I just need to know, like, if there's a fire in a car, I don't need to sit there and go, I wonder what that was. There's a fire in the car.
Yeah.
So
there's smoke coming from the hood.
Right. I don't need to sit there and know exactly what it was in the moment. I need to get out of the car. So to me, the credit markets definitely still flashing red lights. Equities, we've covered plenty. We've got downtrends on our hands, whether you're using a moving average or you're just using price, making lower lows and lower highs, the very definition of a downtrend. Yes, we're seeing big moves in equities today, but big daily moves are what you see in downtrends.
Well, and what if they don't, right? We've got a little over 2 hours left before the close.
Well, no, and that's a good
plenty of time. That's plenty of time where we don't get long upper shadows.
Right. On the weekly. And
on weekly candles.
I know Dan noticed this week with the VIX, there's two ways to look at it. We didn't get above 35. That point is extremely valid. It's been resistance in the past, but we've also been compressing in the VIX since May 5th for like a week, or actually longer, since the end of April. And if we do get above 35, look out, that we could finally get our final flush and then we establish some type of bottom. But we'll see. As always, we got to take it day by day. Closing price matters most, like Ian's alluding to here. We're 2 hours away. You got to let closing price happen.
Yeah, in a 2017, that wouldn't have mattered.
Right.
Probably be pretty comfortable here at 2:00 with what the day was going to look like. But
well, and that's why I called you Amerigo Vespucci, man. Like we're explorers out there, and sometimes it's through the storm, and sometimes it's calm waters, but it's still exciting because you're out there exploring, and that's what markets are. It's ever changing. The only certainty in markets is uncertainty. And while some days it's not easy, some days are more enjoyable than others. You still grind on behalf of your clients and you manage risk, which I'm proud of the team for since the beginning of the year. And so we'll continue to do that. Anything else in the client portion that you want to touch base on before we go into the extended portion of the podcast and talk about some of these weekly candles and downtrends and definitions of secular bear markets and Dow theory?
No, not other than the fact that say we remain pretty bearish and even a 5-8% rally. Again, I always like to say willing to participate for the sake of, if we're going to rally 8-10%, of course I want to be able to capture some of that for clients. Yep. But overall thesis is most likely going to remain that markets go lower.
Exactly. Right. If we've got lower lows and lower highs, let's not overcomplicate this. That's a downtrend. And within downtrends, there are counter trends, and it won't fix anything until we're above important levels.
Even on the February 24th bounce, I was on Twitter and I was like, I highly doubt that this ends up being the lows.
Right.
We'll participate, and we did, and then
rolls back over.
And
that's what happens in downtrends.
We'll see. Just let it keep on set up.
Until we stop making lower lows, it's a downtrend. I know for some, they don't like that simplicity because there's always got to be some explanation or quote unquote, some catalyst. But by the time there's a catalyst, it's too late.
Yeah. So, we've been in a downtrend since all year. So, right. Don't tell me it was Ukraine. Don't tell me it was.
Yeah,
I
we've
guess
seen
what? Now we're on the brink of a potential recession. Did we have negative GDP in Q1?
that's what they reported.
Supposedly?
Yes. Yeah,
Yeah.
supposedly.
So now everyone's worried about, well, gosh, if we get another one, that's technically a recession.
But what do you think the
Well,
market?
no one was talking about that in December
Yeah,
when stocks peaked.
and what's the market been doing since? So maybe it's
Here we are 6 months later.
yeah, maybe 6 months later, maybe we're getting a bigger negative GDP print for the second quarter at the end of June. Who knows? I don't know. That's not my job. All I know is the market
No.
knows more than you, knows more than me, knows more than anybody listening. It's a hard pill to swallow. We all have pride. I get it, but you're better off just submitting to what the market's delivering, which is great information on a daily and weekly basis. So I highly recommend it. With that, we'll close this portion of the podcast down. We'll head on to the extended portion. Everyone have a great week ahead.
Have a great weekend, everyone.
All right, Ian, jumping into the extended part of the podcast. I know we got into the weeds a little bit in the client portion, and that's okay.
We always do. It's okay. It's only natural.
It happens. It's hard to talk shop without using certain things, but hopefully we drove the point home for our clients that the market remains in a downtrend and we continue to manage risk accordingly. In the extended portion, what I wanted to do was touch base on what we're seeing on a weekly time frame with potentially what we're seeing. And you brought up a good point. We have to wait till this close today, but weekly candles, what we're seeing there. And then I want to talk a little bit about what is a downtrend, what's the difference between like a secular bear or something like that, and then maybe some Dow theory if we have some time. So what are we seeing out of weekly candles?
Yeah, there could be some really nice long lower shadows. I mean, take your pick, right? Everything's up a lot off of yesterday's intraday lows. Right now we have to wait to see next week if we get follow through.
Well,
It could be a start.
And what I would say is for a technician, if we do get these what appear to be hammers candles on a weekly basis, all they are is potential and mean nothing until we get follow through. And that's the hard part of markets is you have to wait for follow through if you're doing risk management, at least the way we do it. But as an example, you could make an argument that September of 2008 was a very nice type of hanging man hammer candle, or you could argue July of 2008 on a weekly time frame was a hammer candle, and those subsequently rolled over directly within weeks or directly the following week.
Yeah.
So until you get follow through, it means nothing. We see this across a lot of things. There are hammer candles. Some places it's happening at logical spots. I know, for example, IWM, representing small caps. We touched that gap that goes back to the the breakout in November of 2020. Does that remain gap resistance, or do we fill that gap eventually? I have no idea. But there's plenty of weekly hammers that are developing that we could see a bounce here.
Well, and I'd like to, if I was being real picky, right, there are going to be long lower shadows. Like let's say NASDAQ closes here for the day. One, still going to be close below Monday's open, and it's still going to close below last week's close. So, it kind of is just a lethargic 1.5 day bounce. It ends up happening on a Thursday, Friday. So thus you kind of get this okay looking close to the week. But if we're not closing above Monday's open, and maybe we come in Monday and then it's up another 5% and it's like, okay, here's your follow through. Shut up, Ian. I'm willing to accept that.
We'll listen. We'll listen. No problem.
But we've also got, and we're not going to get into too much detail here, but there are a few, I would say, kind of indicators, metrics internally out there that guys I respect that have put today's action very similar to May 4th. We'll see what happens again here in the last 2 hours, what happens on Monday, but right, May 4th. People very, very bearish, lots of shorts, May 2nd. It's right there with them, They spend 2 days kind of blowing that out. We go all the way back up to 4,300. And then it's right. It's just been downhill since the 5th. So are we getting more? Because I would say the participants is still very much in a buy the dip mentality. Is that, would you say that's kind of what you've seen out there?
Yeah, no, I would agree. In fact, I had a good prospect meeting this week, and the person did say, well, it's good because the market always comes back. And I said, yes, in the history of the US market, if you go back long enough, it always does come back. The issue with that is, when does the area of getting back from stop? Meaning, like, when does a correction stop? And then how long does it take to come out of that? So for example, 2000 to 2003, 2.5 year to 3 year correction takes us 5 years to recover. 0809, 18 months, extreme move, takes 3 years to get back, almost 4. So it's not so much that do markets come back.
13 years stocks went nowhere.
Right. And then I'll see comments on Twitter about, like, show me a period where the US stocks haven't come back. And the caveat there is to use the term US stocks. Like, there's plenty of markets I can show you that never come back.
Well, and don't you have to survive? Like,
yeah,
you have to survive. Like, you've got to have money there when it does turn.
Correct.
If you lost it all, or that's a slippery slope to go down.
Well, and sequence of returns risk, which no one seems to want to talk about, which is simply the power of dollar cost averaging in your 20s and 30s is the opposite power when you're retired and withdrawing.
Yeah.
So you're taking withdrawals to live off of, and your account's cut in half. It's a compounding problem.
Right. You're selling twice as many shares for the same dollar amount.
Right. And so while I love FinTwit, there's a little bit FinTwit representing financial Twitter. Seems to be a little bit of disconnect between the 20 to 50-year-old and the 50 to 70-year-old, meaning it's different. Like, if you've got 10 years to go, I get it. But if you're in it, I don't think you're getting it.
Like, if you just retired.
Right.
There's definitely people. There's thousands of people who retire every day.
Right.
So, there's people that, took their last paycheck December or January, February, and their first 3 months into retirement has been a huge punch to the face.
Right. And so that it's important to understand. I understand that in the history of US markets, it's always come back. That's great. Great. But there are retirees that can't wait for it to come back. They might get to pick where they live, but they don't get to pick their market. That's just reality. And it's a big deal if your account drops by 30, 40, 50%. Great. If you're doing that in your 20s and 30s and your dollar cost averaging in, I think that's awesome. Buy and hold away if that's your thing. Now, I think
right. And the whole thing is that, I'm not worried about the equities. It's only half my portfolio.
Right. I've got these bonds.
I've got the bonds to offset that.
And now we don't. And now we don't have the bonds to offset it. Meaning, like, from a technical perspective, bonds there's more demand than supply. And so they're not protecting portfolios anymore.
And now the question is, do you enter decades of bonds being a drag on your portfolio? Now,
absolutely.
I'm sure there'll be tactical things that.
But as always, things aren't just in a vacuum. They matter on where you are in your life in relationship to the market environment that we're in. And right now, our market environment we're in a downtrend. And if we're in a downtrend and that matches up to a retiree portfolio, that matters.
Well, and how about, I'll give you, last Saturday went to have Mother's Day lunch
Oh yeah. Happy Mother's Day to all the great mothers out there, by the way.
Yes. So Wynn had Mother's Day lunch, and I sat next to my dad, and of course, as always, got to talking about the markets. And my dad, who's spent 30 some odd years of his career in the bond market, fixed income space, he flat out said that, he said, I never thought I would see the day that they did this to, yes, one-off corporate bond, things go bankrupt, but US Treasuries, are you kidding me?
Right. One of the biggest asset classes in liquid environments in the world. It's a pretty big deal.
Nothing is safer than a US Treasury, right?
Right.
Nothing is safer than the US government's word. And right, because that's all a bond is. It's just someone's word to repay it at the end of the day.
Correct. It's on the back of the US taxpayer, right? That's who's paying it back.
Yeah, it's just crazy to see. Bonds back to where they were in long TLT 2014, 2015.
Well, and that's
including dividends.
Yeah.
That's including, you take out dividends, you're back to where you were, below where you were December of 2008.
Well, and you brought up something that in your, kind of off to the side there in your conversation with your dad, talking about corporates. Look at LQD. I had to pull this up while you were talking about it because I was curious. But here we got investment grade corporate bonds on the edge too.
Investment grade. These are not companies that ratings agencies are worried about going bankrupt.
Right. These are supposed to be the best credit instruments.
Blue chips.
And those are, again, starting in 20, I guess you could argue summer of 2020, but January, February 2021 is when things really started to break down in these. But here we are off the highs, 20% in investment grade corporates, and on the verge of breaking through a pretty important level at 111.
Yeah. That
goes back a decade.
Yeah, this is Goldman Sachs, CVS, AT&T, Anheuser-Busch.
Yeah, and to me, we keep talking about these pieces of evidence, right? If we are in the court and we were to lay out the pieces of evidence, and we have some of the most liquid areas in the world in credit, and we're seeing that tighten, whether we're monitoring CCC credit spreads, whether we're looking at corporate bonds, whether we're looking at treasuries, the characteristic we're seeing from that evidence is less liquidity. Markets need liquidity. This market is not getting liquidity. We're seeing a downtrend, lower lows and lower highs. We're seeing flat to falling moving averages, also evidence of downtrends. We're seeing former leaders now breaking down below important levels. We've talked about in the past how in stage 5 of the economic market cycle, it's commodities up while stocks and bonds are down. And now let's throw in Dow Theory. And I know that there's something there, meaning I believe it was Carter Worth who shared a chart. And I'm trying to find it right now. Yeah, it was Carter Worth who shared a chart this week of the world index versus the world transportation index. And I'm going to share it with you, Ian, so you have it, so you can see it while we're talking about it. But that's an important development where you want to see stocks and transportation stocks move in unison. And that's not what we're seeing. We're seeing the world index had diverged higher from transportation index, and transportation stocks are in trouble.
For sure.
We track the domestic ones.
Take Old Dominion for an example.
Okay. Ooh, we like that. We had
love Old Dominion. Old Dominion in an uptrend tells you transports, trucking, economy probably pretty good.
Yeah, that's a great chart, Ian. Meaning from a standpoint of if you're a technician, pull up a chart of Old Dominion, ODFL, and look at the neckline near 286.
Mm-hmm.
We break it, come up, retest. It's a problem. The RSI never gets out of a bearish regime, gets oversold twice.
And that's one of the better truckers.
Yeah, and that's one of the better truckers.
It's really, you take what's Canadian Pacific.
Okay.
Railroads.
Yep. Railroads.
Range bound for
Yeah.
year and a half.
Well, and is this another double top? Because how many charts do we see that have the double top nature that break a neckline?
Mm-hmm.
I'm not saying that's what this is, because we don't get confirmation of that until we're below $64. But you're right. I mean, this thing hasn't gone anywhere since December of 2020. And if that's, it's a pretty big piece of the transportation sector. And so basically transportation did not confirm using Dow Theory. Now, again, I understand Carter-Worth's chart is not your traditional Dow index transportation and regular Dow industrial index, but the essence is definitely there. And seeing transports not match what we had been seeing is further confirmation. It's another thing you would see as a bear market would unfold.
Mm-hmm.
So before we get to wrapping this up, I did want to talk a little bit about definitions of a secular bear.
Okay.
Because we have some pretty cool followers out there. And I know one of them asked us in a tweet whether we would, and I apologize if I don't say this name correctly, but it's Jay Ligon. He's at The Disruptor. He asked, could you talk about primary and secondary bear markets? And some of that might just become down to semantics. So if we just talk about primary trends, so if we just talk about what's the primary trend? So then it matters to talk about what time frame are you talking about. So the primary trend, for example, today in the S&P on a 5-minute chart is, if we just looked at today, is up, but now rolling over. Now, I'm talking about 5 minutes. If you look at a daily chart, the primary trend of the S&P is down because we're making lower lows and lower highs. Then if we talk about secular, like a secular bear market, another word I would use for that is protracted. So something that lasts longer than a year or a couple months, because once every 4.5 years-ish, the data shows that we have some type of 20% correction-ish.
Uh-huh.
And that can just be cyclical. It could be what would be called a cyclical bear.
Once every 4.5 years. Huh.
Right. Yeah, I know. We laugh at that now because since January of 2018, we've had, yes, you could argue 4 corrections of that magnitude or more, which is above average. Again, from that time frame, volatility increases at turning points. So that's a huge time frame, changes at turning points. Anyway, secular or protracted bear, you could use those a little bit interchangeably. Protracted just meaning it's a bigger type correction. So your 2000 to 2003, your 08 to 09, these are multi-month corrections. And right now the thesis lines up for that. And until we reclaim the levels that Ian's talked about on something like S&P 500 or Apple or Microsoft, that thesis isn't still in play. And the beauty of theses is that they can be refuted, and it keeps your mind open to possibilities. I'm completely open to that. This was a secular correction.
What would you say, like 2015, 2016?
I would say that was cyclical.
Cyclical, yeah.
I would say that was cyclical. The correction happened underneath the surface before that. If you look at a lot of sectors and charts, what was going on underneath the surface starting back in 2014, there was definitely some type of correction happening underneath the surface that the broad indices caught up to. And we subsequently moved higher. Just like if we reclaim 4175 on the S&P and continue to move higher out of this was a cyclical correction.
And didn't we technically wasn't 94, 95 kind of a bear market for some places? Or maybe I'm thinking more 90, 91.
I would answer yes to both of those.
Okay.
That there were things happening underneath the surface that would have been considered a cyclical correction, even though the broad indice didn't necessarily reflect it.
Yeah, 94, 95. She had an 11% correction, but you went not even 11%, but you went sideways for January 94 to March 95.
And hopefully that provides some context that cyclical is something that happens within a secular bull. So you have a secular bull market. Within that are cyclical bears. So secular and cyclical, they sound somewhat the same, different words, but they're counter trend corrections within a primary uptrend. A primary downtrend that extends over time would be your protracted or secular bear. Is this the beginning of a secular bear? Could be. We don't know. There's no way to know that other than to have continuing evidence line up that way. So is this 2000, the beginning of 2000, 2001, or the beginning of 08, 09? Again, I'm using recency bias. You could look at the 70s for similar type behavior as well. One fractal we looked at this week that's notable is if you go back and look at the chart of the Qs and its top, and you go look at the top in fintech using something like XITK that just happened last year, very similar behavior, which potentially you could see some of these tech and software things sell off further than you possibly could imagine, because we tend to overshoot, we tend to mean revert. So hopefully that provides some. We are definitely seeing lower lows and lower highs, very definition of a downtrend on a daily and weekly time frame. Whether this turns into a secular bear is TBD. We don't know that, to be determined. You just have to continue to watch the evidence. At minimum, it's a cyclical correction, a correction that's taken place over a year. Whether this turns into something longer is to be determined, but the evidence continues to pile up for that. So hopefully that answers that question. Ian, anything before we wrap up the podcast now that we're up against the end of our time?
No, I mean, other than I continue to think that this, I just don't see any like capitulation-y type behavior yet.
Yeah, capitulate.
Not as bad as it was Christmas 2018, not as bad as it was March 20. Now, I'm not saying it has to get to those levels, but still, I mean, people, right? And the indices are down 15 and ARK's down 70, and it's definitely still much this. I mean, there's no way that these small cap growth stocks could go any lower. Obviously, we know that's not the truth, right? And I think someone had a great example. Like during 2000 to 03, like Amazon grew sales by some ridiculous amount, like 100%, 200%, and the stock was down 90% during that same time frame when they were just blowing out sales estimates. So I don't know. It's just another piece where the stories, a lot of these story stocks are just falling apart. And it might not be till next cycle that we're going to find out who the winners and losers are, right? You didn't really find out till 04, 05 who survived the dot-com bubble.
Yeah,
it's not like you knew. It's not like you knew in March 03. Oh, okay. Now, just because they haven't gone bankrupt yet, so they're gonna, they'll make it out.
Right. And Amazon was one of those. And
Mm-hmm.
I think that's a great point that you're bringing up. And I'll try to do this quickly. There's enough short fuel sitting out there that we could see a quick leg higher up to new highs, and that ends up being an exhaustive high. And then, yes, we truly go into a secular bear, or we continue to be in a downtrend and the secular bear has begun. And I don't know there's not many people talking about a secular bear or a protracted bear.
No.
But one of the benefits of corrective markets is you should be looking for relative strength, because that does tend to be who are the primary leaders of the next leg higher.
I mean,
so it is
got a lot of people. You got people on the sales out here sell research and stuff telling you to buy ARK. So
yeah, I don't know about that.
There's a lot of bottom calling going on out there.
Yeah, we'll just let price do its thing, and that's the beauty of having charts. Is I don't have to be the smartest guy in the room, and I don't have to buy into narratives, and I don't have to marry my opinion. I get to just enjoy being married to my wife and have my kids and my family and you guys in the adaptive team and our clients, and just stay disciplined to price and not worry about my own doggone opinions, which, man, how often are they wrong? So with that, Ian, awesome to be back on the podcast with you this week.
Yeah, man. Great to have you back.
And
fortunately, I guess I'm
No, not unfortunately. I was just going to
Yeah.
say you have a well-deserved vacation next week. I love that you're taking your family on vacation. Well-deserved. You've been grinding, doing an awesome job for our clients. Time to get some R&R with your fam. Enjoy it.
It will be. It will be. This year has been, well, I mean, it's been a continuation of 2021, but
It's real,
it
man.
will
You're an
be.
explorer. There's not every day
Exploring.
is calm waters. So you're appreciated. Your work is appreciated. Take care of that wife and kid of yours and enjoy the rays out there. Can't wait to hear all about it. We'll make Dan and Kevin join me next week, mainly just Dan, because I think Kevin's off next Friday as well. But anyway, you enjoy your time off. Everybody listening, we appreciate it. And we'll do it again next week.
Have a great weekend, everyone.